Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So it's Super Bowl weekend, and as a Philadelphia Eagles fan, I don't care, since the Birds flamed out early. I'm waiting for the Olympics opening ceremony. But as an investor, you're supposed to care, because if the NFC champ wins, that would be the Seattle Seahawks, stocks will rise the rest of the year. If the AFC champ wins, the Patriots, stocks sell off. So says history. Since 1978, the NFC team has won the Super Bowl 27 times, and 74% of the time, stocks rose over the balance of the year. Go Seattle. This week, our three things are: 1. Margin lift. They're high and expected to go higher. And 2. Excitable risk. Volatility is back. Just how much matters to credit fundamentals. And 3. The path of interest rates. The consensus is calling for a 4 basis point range for the 10-year over the next 6 quarters. What does that tell you? All right, let's dig a bit deeper. Margin lift. So we've noted for some time now that corporate margins were at or near historic highs. That's the result, in part, of the effect of phenomenal wealth creation in the U.S. since the GFC, led by technology behemoths that have revolutionized much of our day-to-day. Still, not all firms enjoy the pricing power and operating leverage of the tech giants, and the operating environment has been challenging, to say the least, with disruption of said technologies, 40-year inflation, and rapidly changing geopolitical landscape. So it comes as a bit of a surprise that the net profit margin for those S&P 500 firms that have reported Q4 earnings thus far, just under half that universe, are tracking margins at 13.2%, which would be the highest in more than 15 years, according to FactSet. Margins have rebounded solidly from the recent trough of 11.2% recorded in the fourth quarter of 2023 at the end of the most aggressive Fed hiking cycle in 40 years. Now, leading the way, no surprise, is the aforementioned information technology sector, which is operating at margins 29%, more than double that of the broader market. Financials, real estate, and communication services are also reporting above the broad market average. The biggest margin gainers year over year are infotech at 2.2 percentage points and industrials at 1.8 percentage points. While 5 of the sectors showed margin contraction versus a year ago, none of those lost as much as 1%. We attribute the outperformance to the surprisingly strong economy, which is benefiting from returning animal spirits, deregulation, tech capex, which is driving in turn a historic wealth effect, and a productivity boost. Analysts believe we are in the midst of something big. Net interest margin is expected to grow in each of the next 5 quarters, reaching 15.5% in Q1 2027. Irrational exuberance? Well, time will tell, but this backdrop is constructive for credit. All right, on to our second thing, excitable risk. Lots of angst spilled over into risk markets this week if we reduce risk markets to the Mag 7, software firms, silver and gold, and crypto. Risk storylines have been reduced to these elements by the media because, well, that's where the stories and the volatility are. Call it risk introduced into markets by those that are excitable. Now, what matters to credit? Now, something very different, the broadening out trade. We find it fascinating that the year-to-date total return of the equal-weighted S&P 500 at 4.6% has outperformed the S&P 500 cap-weighted by 400 basis points and the NASDAQ by 600 basis points. In credit, broad-based measures are, well, fine. Public investment-grade credit spreads are tighter. Public high-yield credit spreads are tighter. If we take these asset classes one by one, a far less ominous picture emerges. Mag 7 selling reflects a correction from very high earnings growth to something less than that, reflecting the mathematical burden of growing something on ever-increasing size. Silver and gold and crypto, well, safe to say those are markets that do not reflect something all that fundamentally meaningful to credit. The sell-off in software, however, does represent something more meaningful to credit, in that it is a reminder that AI is not just about productivity gains, it's also a disruptor story. But today, software represents less than 1% of the Bloomberg US Ag, according to JP Morgan Investment Management, less than 5% of the high yield index, and around 15% of leveraged loan index. Contagion and the impact on broad investment performance has been limited, but AI's impact on certain industries and eventually employment is going to be the longer-term thematic worth watching. In the meantime, I like this quote from Stefan Slowinski, Global Head of Software Research at BNP Paribas. With regard to AI, he says, expect more models, more infrastructure, more money, and more uncertainty. All right, on to our third thing, the path of interest rates. Finding neutral, the rate at which monetary policy is not stimulating or restricting economic growth, has been described as central banking's holy grail. It cannot be observed, so it's all feel. Chair Powell has said we are, quote, within a range of plausible estimates of neutral, unquote, which we take to mean risks to the dual mandate, to employment and to inflation, are close to balance and close to targets, which means we are near the end of the cutting cycle. The median of the December FOMC projections have the policy rate falling to 3.4% by year-end 2026, essentially one cut away. Today's Fed funds futures market is pricing in between 2 and 3 additional cuts over the course of 2026. Additional cuts would be welcome news to housing, the sector where mortgage rates clearly remain restrictive. Historically, mortgage rates have been influenced directionally by the Fed's policy rate, but of course the 10-year Treasury is far more meaningful. And surprisingly, the 10-year yield has moved higher since the Fed began its most recent cutting cycle back in September of 2024. After 175 basis points of cuts to the policy rate, the 10-year sits 48 basis points wider at 4.18%. The culprit driving rates higher, we would argue, is rising debt and deficits in the U.S. and concern that inflation could reverse from its position near target, excluding one-time tariff adjustments. The economy is running hot. Atlanta Fed GDP now, Q1 estimate is 4.2%. And additional fuel is on the way in the form of tax cuts and incentives under the One Big Beautiful Bill Act, additional infrastructure spend, those past rate cuts that are flowing into the economy, and the historic wealth effect primarily from the run-up in stocks. All of this runs the risk of putting upward pressure on rates. Now, there are cross-currents working against all of this, namely deflationary forces largely from technology application that presumably are behind the recent surge in productivity. And for what it's worth, the Bloomberg consensus has the 10-year moving in a 4 basis point range over the next 6 quarters, between 4.11 and 4.15%. Well, of course, that would be great for credit, a kind of Goldilocks environment. The flip side is that with all of the moving pieces, an essentially no volatility forecast suggests uncertainty is on the rise. So there you have it. 3 things in credit. 1, margin lift. Businesses have adapted to the challenging environment well. 2, excitable risk. Away from the shiny objects is broad-based stability. And 3, the path of interest rates. With the economy performing well and stimulus on the way, we see risks to the upside. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.